Let's get into some stocks. Joining us, Mr. Ross Gerber of Gerber Kawasaki, President and CEO, wealth and investment management firm. Good to have you back, Ross. Hey, remind me, I think it was early 2020. I don't know if you heard my tease there into our block as Marta was telling us about buying bonds. There was one point during the bear market that you told me, hey, I'm buying treasuries for the first time in a while. Is that still playing a role in the Kawasaki portfolio right now, or is it all Tesla autopilot?
Tesla and Nvidia, yeah, that's like our portfolio: Tesla, Nvidia, and a bunch of treasuries. It's played out pretty well. It's not really our portfolio, but you know, we started buying short-term treasury bonds at the end of last year. You know, as rates had really gone up, what we thought too high, and we bought mostly like within a year or less, knowing that rates would continue to go higher. And we've been rolling over those bonds as they mature and buying higher and higher yielding bonds. The bonds I'm buying today yield 5%. You know, I just bought some today that were like, you know, a year and a half to 2 years out, paying 5%, almost 5%. You know, it's really attractive for people, you know, to get a guaranteed risk-free rate so high. And then on top of it, you know, growth stocks are back. You know, higher rates have put a lot of pressure on growth stock portfolios like mine at GK, and now that we are at the peak for rates here, you know, people are realizing, look, the next move for the Fed into next year is lower, not higher. This whole talk about higher rates is insane to me. It's like insanity. Like
isn't the definition of insanity doing the same thing over and over again, and the market keeps pricing in cuts and keeps getting it wrong? So the market seems kind of insane too.
No, the market is very clear that the Fed has over-raised rates. I mean, the 2-year is still sitting here at 5%. The Fed's at 5.5%, and then you got the 10-year at 2, and you got an inverted yield curve in a strong economy. Okay, that means the Fed isn't paying attention to the market, and so right now we have some of the biggest imbalances in banking and real estate that I have ever seen. And I don't know how that rectifies itself, but banks basically are in a horrible position thanks to the Fed. Homeowners, like if you have 2 kids and you're living in an apartment, you want to buy a house, good luck with that with 7.5% mortgages. So, you know, they've really put a lot of pressure on certain industries while the rest of the economy, you know, is doing fine. So it's a really arbitrary way to slow the economy, and it's working for sure. But, you know, the Fed will have room to lower rates 50 basis points easily into next year or more, and that will give a lot of ammunition to stocks moving forward. And that's why I think people are buying stocks today, is they're looking out over the next couple of years and know that this is the peak in rates.
Peak in rates, but as we just discussed there with Marta, a strong case that she would make many others, that peak doesn't equate to the reversal in rates that you're talking about, that the market has kept getting wrong. So where is that confidence? I mean, because you're buying these other companies because you like Nvidia's AI breakthroughs, right? You like Tesla's breakthroughs in technology. I mean, you're an Apple guy, I feel like, normally, unless something's changed. I mean, if you're long these stocks, you got to have some hope in the consumer's buying ability. So how do we cut rates in an environment where a company like Nvidia apparently is revolutionizing tech? I mean, won't that be good for the economy?
Well, it's good for the economy. It's bad for jobs because, you know, every tech innovation, you know, actually hurts jobs. So when you look at what AI really does, is it eliminates an entire layer of sort of like middle management in a lot of ways. So AI productivity will have dramatic impact on communities like the legal community, you know, associates and legal secretaries. You know, these jobs are at risk thanks to AI. And so companies that have no debt like Nvidia and Tesla are really in the driver's seat as they grow their cash flows. You know, they have lots of leverage in their businesses and they have no debt, you know, so the Fed doesn't really affect them. As far as the consumer is concerned, it's all about jobs, and people have jobs. And the whole reason the Fed is bearish is because people have jobs and they're making more money, which is kind of a weird thing too, because I thought that was the goal of America, was like, you know, capitalism is good, not, God forbid, people make money here in the United States, especially on the low and medium income earners are making more and more money, and this is great news. So I think we just interpret things differently. I look at this super core as a great thing that wages are going up 4% in America for people, and while inflation is less than that, that means their real buying power has been growing, and we're seeing those numbers in Vegas. Like my holding MGM just reported a great month for gambling in Vegas. Really strong numbers. Football season's about to start. The consumer's out. The consumer wants to live their life and enjoy their life. They all have jobs.
Sure, fair enough. Yeah.
So what we really need is the Fed to back off and let rates play out over the next 6 months, because there's a lot of these imbalances that will play out over the next 6 months, which will continue to put pressure on pricing. And then they've got this ammunition if and when the economy does slow to then lower rates. So they're really in a good position if they just stay where they are and just wait and see how the fall plays itself out. But this reacceleration of inflation thesis is absurd to me.
Okay. Point noted. Let's talk Tesla for a sec while we got you, for sure. The autopilot, Elon mode, pseudo autopilot, government is a little bit worried, Highway Traffic Safety Administration, et cetera. Is there a real limitation to this as a growth engine for the company or as a draw for the products if the government's going to try and push back on it this hard? How does it affect the case for owning Tesla and the case for them beating their peers selling cars?
Well, first of all, this whole Elon mode thing is way overblown. I don't know how to do that. I use full self-driving every day.
We know. We saw the video.
Yeah. And so, for me, full self-driving is making great leaps forward every couple weeks. It gets better and better and better. And we're getting to a point where the cars don't need you nagging it all the time. Quite frankly, it's really annoying because the car drives really fine. And, honestly, Tesla could do a better job probably communicating with the public about what's going on and the safety features. And this is what I've been, pushing them to do. Maybe they'll do that. But, the truth of the matter is I was stuck at my house yesterday all day because some truck driver crashed on PCH, and the entire city was stuck in West LA because of one human. So let's be real. Humans are dying at 100 people a day on the road. And the sooner we get this technology out, the better off we will all be. So let's cut the nonsense with the NTHSB or whatever they're called.
All right. Ross, thanks for checking in with us as always. Appreciate the convo.
Yeah, thanks.
All right, you got it.